Welcome to the launch of the Australian Small Companies Fund. My name's Gaurav Sodhi. I'm Deputy Head of Research at Intelligent Investor. I'm joined today with two of our senior analysts. We have Alex Hughes. Say hello, Alex.
Hi, guys.
And Jon Mills is with us as well. Welcome, Jon.
Hello, everyone.
Guys, we're here to answer questions that are coming in, and I see there's already a couple there now. Before we get to those questions, though, I thought we'd just introduce what we're trying to do with the fund a little bit. Alex, why small caps?
It's an area of the market where we think we can add value through active management, and it's been an area of the market that Intelligent Investor hasn't covered in the past. They've tended to cover sort of the mid to larger cap companies. So it's a new area for us, but we think that it's an area of the market where perhaps there's some inefficiencies there, and if we start to drill down and research some of these companies, we can add some value there and provide a decent service to some investors.
Lots of companies simply can't invest in, lots of funds can't invest in smaller companies. They're restricted by size or by mandates. What are some of the other sources of inefficiency in smaller companies?
Exactly. I think you can use the term structural inefficiency because, as you said, there's reasons which prevent many investors from investing in the sector. So illiquidity is one. So if you manage a lot of money, it's very difficult for you to invest in the smaller cap space, and that really keeps a big portion of the institutional market out of the small cap area. And of course, on the research side, a broker just can't justify spending the time to understand a company when the potential brokerage commission pool is very small there. So, those are two things which are very real and are likely to stay there for a long time. So, it provides an opportunity for smaller guys such as ourselves. We want to stay small. That's our key focus, and we want performance to be the priority.
Now, correct me if I'm wrong, fellas, but we are all committed to running a fund that generates outstanding returns. I don't think we're interested in running a larger fund that generates slightly above average returns. I think we're all in here to generate very good returns, even if that means running a smaller fund.
The first stock that comes to mind is iSelect, which was a speculative buy a couple of years ago.
At a terrific price, wasn't it?
Yeah, well, we took advantage of what was panic selling.
Yeah.
Now, there were some reasons why investors didn't want it, but there was management turnover and there was some shenanigans happening in the background, and there was profit warnings, all sorts of things going on, but just the price was so attractive that we recommended it to members. It's done well since then, but we still think it's cheap, and it's more importantly, it's got a decent future. For those who don't know, iSelect is the comparison website. You've probably seen the ads. They've retired Mr. iSelect and they've got different ads.
Yes, I noticed that.
They're constantly advertising. They spend something like 30% of revenue on marketing. And apparently, they're one of the best known brands in Australia. And so they're able to get all these people to go to the websites and compare health insurance policies or life insurance policies or car insurance and a number of other energy, broadband, number of other products. And they've traditionally been mostly health insurance, but they're gradually diversifying. And we think that there's going to be a big opportunity with the NBN rollout. Everyone will be forced to choose an NBN provider over the next, 4 or 5 years. And also with energy prices rising quite significantly.
I haven't noticed, actually.
Yeah.
What I really like about this business and the investment case is that the company has far too much capital sitting in its structure, surplus capital that it can hand back to shareholders. Now, that's a way of generating returns for investors that doesn't reflect on a PE. You won't find it if you're screening. So it gets missed by a lot of investors, but it is a definite way where we can get cash back from the business without it being reflected in the share price. And I think that's...
Yeah, and in fact, that's what they've been doing.
That's exactly what they've been doing,
They're buying back a lot of stock. They've started paying a dividend and now increased it quite significantly.
Yeah.
There's certainly a lot of surplus capital there. It's by no means a highly capital-intensive business. Biggest expenses are marketing employees, and one of the things they've done on the employee front is that they're expanding their office in Cape Town, which is obviously cheaper. Wages are cheaper over there, but it also expands the hours in which they can interact with customers. So it has a few benefits there, and it looks very cheap. Well, it looks pretty cheap at the moment. Hopefully, you can take advantage of the opportunities and do well for the fund.
Okay, I'll talk about one of the more recent ideas, which would be Adicel. So this is a company that we have written up in the publication. It's a software business that has a large operation in the US and the North American market. And it has two businesses. It provides a training solution that air traffic controllers use to train and become employed air traffic controllers. And it also has the software that's used by air traffic controllers in their line of work. And we like this company because it's a very high quality company. It's got about 90% market share in the training product. And so if you want to become an air traffic controller in the US, you have to use this product. And so it has great sort of an entrenched business model there, great cash flow characteristics. And we think it has a bright future ahead as more air traffic controllers are trained and the market grows. And also the international air traffic management business. So this is what the air traffic controllers use in the line of work. Used all throughout the world, very entrenched. Once these systems are installed, they're there for a long time. I've heard analogies about the US air traffic management market, and they're still using a system that was installed 40 years ago, and it's very difficult for them to move off that. So that just shows just an indication of how robust a product like that is. So it's one of the recent additions there. It's done reasonably well thus far. It's been a bit problematic when you're trying to build a position and the stock's going up, but yeah, we think Adacel has a pretty good future ahead.
But we have a very specific process we use. It's actually very similar to the process we've used for over 20 years in selecting stocks for our larger portfolios. Alex, it doesn't change very much, does it?
It doesn't, and it involves assessing a company on its merit. So it might differ between companies you're looking at. To provide an example, maybe RPM Global, which is a mining software company that the members will be familiar with. We've written it up on the site there. We like it because we think it has the potential to be a much bigger business in time. So we appreciate the opportunity the company has in front of it. But what we're thinking about on a day-to-day basis is, do they have the right strategy? Are they executing on that strategy? And are they meeting expectations on an incremental basis?
How do we think about cash in this fund?
I think cash gives you the option of taking advantage of cheaper prices. So I think the cash weighting could be anywhere between 0 and 50%. Now they're the extremes. I mean, over the long term, I think it'd be closer to 10 to 20%. But it'll all depend on the number of opportunities.
So at the moment, our cash holding is?
I think it's about 30%.
Yeah, it's about 30%. It's a fluid situation now because we are getting flows.
Yeah, so we're trying to put those flows to work.
Yeah.
How do you think about cash in the fund, Alex?
Yeah, in similar terms, I think it provides optionality. So you want to have some when you need to put it to use and when there are opportunities there. And this fund is a little bit different because we are subject to redemptions and we also have illiquid stocks. So we need to have higher cash balances than perhaps the SMA product.
Yep.
Just to meet those two forces there. So
that's a really important point. So for a lot of people watching, 30% may sound like an unusually high balance, but you're right. When you consider that we have to have some cash in place to meet redemptions, and also some of our positions are very illiquid, and we do need cash in place in case we cannot sell them or need a bit longer to sell them. So for us, yes, cash is a buffer and a weapon, and depending on how the market is doing, we can either use it as a safety net or use it as a spear.
That's right. But I would regard 30% as being marginally underinvested at this point.
Yeah, I would agree with that. I think we're all looking for somewhere to put it.
Yeah, I mean, we've got ideas we're working on, so that could change in the medium term.
Talk to us, John, about the structure of this specific fund.
Yeah, so with the growth and equity income portfolios, you can invest in them via SMAs. So that means you are the legal and beneficial owner of the securities in the portfolio, and your money isn't pooled with other investors in that model portfolio. The small cap portfolio is, by contrast, a unit trust. So that means if you choose to invest, your money will be pooled with everyone else, and then that'll be invested in the various holdings of the fund. Now that has tax effects as well. In an SMA structure, your tax situation depends on how or when you invested and what happens to the underlying holdings. In the unit trust, your tax situation to a great extent depends on, I guess, previous tax events that have happened, or previous events that have happened before you became an investor.
There are lots of advantages to the SMA structure. I like it a lot. But when you're investing in smaller and potentially illiquid businesses, the SMA structure does not work. And so we've specifically chosen the unit trust structure because that's what suits the kind of companies that are going to go into this fund. The thing I think about using a fund structure for accessing smaller companies is that it allows you to outsource your portfolio management as well. You know, there are two ways to make money in the market. One is with great stock selection, and the other way is really good portfolio management. I think with larger companies, it demands less portfolio attention. With smaller caps, you really have to watch your portfolio management far more carefully, and it's a more rigorous exercise. So inside this structure, you get access to our own stock selections, but you also get access to our own portfolio management. And we're watching those things all the time, adjusting weightings and taking profits as we see fit. So I think that's another important part to generating returns in this part of the market.